The great challenge that you and I face with this whole investing thing is how do we allocate or invest our savings so we can create more of it? Well, at the most simplistic level, there's four ways for us to do this. One option is to lend it. Lend the money that we have to somebody or a company and make them with a promise, essentially, that they're going to pay the money back to us in the future at some point in time, plus a little bit of an additional cost to kind of compensate us for the fact that we're parting with our money. And that's just a nice fancy schmancy way of calling interest. So that's the first option, is to just lend it out. And hopefully we'll get the money back and we'll get a little bit extra. The second way we can do this, we can grow our savings, is kind of take an entrepreneurial route and start our own business to sell a product or service that's hopefully going to generate enough cash flow to cover the costs of obtaining capital. That's another way we can do it. Just hang a shingle and get out there and pound the pavement and start selling our own gig. The third way we can do it is maybe invest our savings and operate another already established business, like a franchise, like a Tim Hortons, a Subway, a Chipotle, McDonald's. Businesses that have a track record, that have demonstrated that it's capable of generating a lot of cash flow to cover those initial capital costs. And in a way, it's kind of like starting your own. It's kind of a hybrid of starting your own business. It's a more established one. This one is all about just starting something brand new, spanking new. So that's another option. We can grow savings. And finally, the last option that we have, and the one that probably most of us follow, is to essentially outsource our decision making, outsource our capital allocation decisions to a steward, which can be a portfolio manager, it can be a financial planner, it can be a financial advisor. It's not an investment coach because as an investment coach, I don't invest for people. But it's these traditional kind of roles that I'm talking about. People who are essentially experts, who have been trained and have an education, and also important, have demonstrated success in investing money and creating tangible wealth. We can also put our money through a financial planner, through a financial advisor, a broker, that type of relationship, or we can go our own way and invest the money ourselves, buy individual stocks, ETFs, and we'll talk about what ETFs are and everything. Buy individual stocks like buying Apple or Starbucks or buying stock in a company. Those are essentially the four ways we can grow our savings. Now, what's constant, they're all very different paths, but they're very similar in the sense that each one of these concepts or paths that they have carries a risk that you could lose some or all of your savings at different degrees. For example, if we lend our money to the Government of Canada by purchasing a Government of Canada T-bill, we can be pretty sure that they're going to, if it's a 30-day T-bill, we're pretty sure that on day 30, they're going to pay us back the money, our principal, and they're probably going to pay us some extra money, which is interest. You can't say that if you were to invest in a biotech company in Argentina that could potentially get seized by the government, have their assets seized by the government. Totally different risk profile and a pretty good that the potential is there that you could lose some or all of your money. So risk is a key factor in all of these. Plays a role. And it should play a role in how we determine what type of products we want to choose to include in our financial plan or in our investment strategy and ultimately in our portfolios.